Good morning, good afternoon, good evening. Welcome to our 2020 Q4 Global ACS webcast. I'm Marie Kling. I'm a partner in our global accounting team, and today I'm joined by two of my fellow partners from the global team, Gary Berkowitz and Scott Bandura. So in this webcast today, we'll focus on key considerations for year-end reporting. We'll start with climate change, with a particular focus on the financial reporting aspect of climate change. And then we'll switch to other areas of focus for year-end reporting and share some key reminders with you. So feel free to use the timestamps in the description below the video if you want to go straight to one of the topics we're discussing today.
Hello, I'm Scott Bandura. Climate change and its impact on businesses is generating more and more discussion, both in the context of financial and non-financial reporting, such as environmental, social, and governance, or ESG information. ESG reporting is evolving around the world, and some territories are further along than others in this area. We can almost draw a parallel to the pre-IFRS world, where there was not necessarily one generally accepted framework or way of reporting this information. Various bodies around the world are weighing in on non-financial reporting and considering whether one set of global standards might be appropriate for reporting on ESG type information. In September, the IFRS Foundation trustees published a consultation paper to assess demand for global sustainability standards and noted that if demand is strong, they will assess whether and to what extent the foundation may contribute to the development of such standards. One possible option outlined in the paper is a new sustainability standards board operating alongside the IASB. The Institutional Investors Group on Climate Change recently sent a letter to the audit committee chairs of 36 of Europe's largest companies, detailing investor expectations for Paris-aligned accounts. They said not only is it important that boards ensure consistency between their narrative disclosures on climate risk and their financial statements, that is, it would not be consistent to emphasize climate risk in the strategic report but not consider these same risks in the accounts, but prudent capital allocation depends on Paris-aligned accounts. This is just one of a number of letters that have been sent emphasizing the need to consider the impact of climate risk on financial reporting. In November 2020, the ISB board published some new educational material, Effects of Climate-Related Matters on Financial Statements, to support consistent application of IFRS requirements to climate-related matters when their effect is material to the financial statements. The educational material complements an article that IASB member Nick Anderson wrote on this topic about a year ago. So as you can see, there's a lot going on in the financial and non-financial reporting space. Today I'm going to focus, though, mainly on the impact on financial reporting. First, we'll take a look at what the ISB's educational material on climate change covers and how IFRS considers climate change assumptions at the moment, and then we'll consider how companies might tackle the impact on their financial statements. IFRS does not mention climate change at all. However, clearly, climate change can have an impact on the financial statements and the assumptions used in measuring various items. This can be because of climate change risks or also because of a company's commitments to improve environmental metrics like carbon emissions. Companies must consider climate-related matters in applying IFRS when the effect of those matters is material in the context of the financial statements taken as a whole. As a reminder, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that users make based on the financial statements. The ISB educational material includes examples that illustrate when IFRS standards may require companies to consider the effects of climate-related matters. Overall, companies are also reminded that IAS 1 requires additional disclosures when compliance with the specific requirements in IFRS standards is insufficient to enable investors to understand the impact of climate-related matters on the company's financial position and financial performance. This might be quite relevant for companies whose financial position or financial performance is particularly affected by climate-related matters. If assumptions a company makes about the future have a significant risk of resulting in a material adjustment to the carrying amount of assets and liabilities, IAS 1 requires disclosure of information about those assumptions and the nature and carrying amounts of those assets and liabilities. For example, if climate change-related matters create uncertainties that affect assumptions used to develop estimates, those assumptions should be disclosed. Entities should also consider the impact to going concern disclosures of climate-related matters. Let's talk a bit about impairment of non-financial assets, because this is a very common areas that companies are asking about, and I'll go into a bit more detail on this. So for example, let's consider a company that voluntarily commits to reduce carbon emissions for a particular operation by 30% by 2025. It does not expect that regulations would be imposed requiring such changes. This set of facts could have an impact on a variety of estimates used in the financial statements, but let's focus on impairment for a moment. The company may have to make some capital expenditures to meet this target and also potentially incur higher operating costs in the future. If a company is testing a cash-generating unit for impairment, it would have to consider the impact of these initiatives on the assumptions that it is using in the recoverable amount. These initiatives could have a positive and negative effect on cash flow. For example, the improved environmental metrics could have a positive effect on revenues if some customers are willing to pay a premium because of the improved environmental impact of the operation. And this could somewhat offset the increase in operating costs. Recall that if an entity is required to calculate the recoverable amount, it's based on the higher of fair value less cost of disposal or value in use. And let's assume both of these measures are being calculated using discounted cash flows. Tackling fair value less cost of dispose first, the question would be whether a market participant would make similar assumptions about the need to improve the environmental aspects of the operation, and if they would, whether similar assumptions about the future capex, operating costs, and revenues would be made for the operation, similar to what the company is planning. If a market participant would not assume these changes, they may not be factored into the fair value less cost of dispose before they actually occurred. In terms of value in use, it's a bit more tricky because IAS 36, the impairment standard, indicates that future restructuring or improvements or enhancements to an asset's performance should not be taken into account until those projects have at least commenced. So this raises questions about how to deal with these types of changes in a value in use calculation. So that example was a discussion of a voluntary initiative to improve the asset's performance, but in other cases, it might be expected that more stringent environmental regulations will be imposed by a government for the operation. To the extent that that it is expected by market participants in the case of a fair value less cost of dispose measurement that such environmental regulations will have a negative impact on cash flows, they should be included in the company's estimates. For example, because it is expected to be mandatory to improve emissions, or because of penalties or costs that might be expected to be incurred. Again, how to deal with value in use can be more complex in this case, particularly where some changes are anticipated to be required to maintain the CGU's operation or to avoid penalties. To even further complicate things, there could be situations where a company plans to voluntarily improve an operation's environmental performance earlier than is anticipated to be required by regulations. There may be different scenarios where environmental regulations are forecast to be put in place at different times or with different levels of stringency, and therefore sometimes multiple scenarios may need to be built into the impairment testing to deal with these inherent uncertainties. Such uncertainty can also have an impact on discount rates used, where there's higher potential variability in future cash flows. And so entities should remain careful that the same risks are not double counted in both the discount rate and the cash flows. I think our discussion highlights that this is a complex area for companies to work through, and as with other areas requiring significant estimates, the company should consider whether they are meeting the disclosure objectives of the standard and really telling the story of how they've factored in various scenarios or assumptions in the impairment testing. Other examples provided in the educational guidance about possible climate-related impacts include inventories. So for example, inventories may become obsolete if they're not recoverable. In IAS2, the inventory standard requires a company to write down those inventories to their net realizable values. There's also a discussion of deferred tax assets, which are only recognized to the extent that there are probable future taxable profits. Climate change may impact a company's estimates of future taxable profits and may result in it not being able to recognize a deferred tax asset or lead to derecognition of those deferred tax assets that had been recognized. Due to climate change, one might need to also incur expenses to change business activities, including research and development. and IAS 16 and the PP&E standard in IAS 38 dealing with intangible give guidance on what costs can be capitalized. Useful lives and residual values of PP&E and intangible assets may also need to be updated. On the liability side of the balance sheet, climate risk can have an impact on the recognition, measurement, and disclosure of provisions and levies. So, for example, restructuring provisions or environmental or decommissioning obligations may be impacted. Classification and measurement of financial instruments can also be impacted. So, for example, one would need to consider the impact of ESG features included in loans, such as green loans. For the lender, the question would be, do the contractual cash flows meet the solely payments of principal and interest test for the classification of those instruments? For the borrower, the question would be, is there an embedded derivative to be recognized separately? When considering impairment of financial assets, climate change may impact the range of potential future economic scenarios that's used to calculate expected credit losses. Financial instrument disclosures may also be impacted. IFRS 7, dealing with those disclosures, requires information about the nature and extent of risks and how a company is managing those risks. Disclosures that might be impacted include things like the disclosure of expected credit loss assumptions, concentration of credit risk, and concentrations of market risk. Fair value measurement and disclosure can be impacted wherever fair value is used, particularly for items classified as level 3 of the fair value hierarchy, because market participants may include assumptions about climate-related risk. Last but not least, climate change may impact the assumptions used to measure insurance liabilities. For example, climate change may increase the frequency or magnitude of insured events or accelerate the timing of their occurrence. How can companies tackle all of this? Well, I think the first step is really understanding the impacts for your particular organization. Obviously, some industries that are carbon intensive could be more impacted than lower carbon intensity industries. In many cases, you'll have sustainability or environmental functions which are developing your plans in response to climate change. It's important that those involved in financial reporting stay in close contact with those individuals and make sure that the consistency with estimates and assumptions used in financial reporting is well thought through and documented. This is an emerging area, and controls over gathering such information may not be as developed or robust as controls in other areas. Companies should be considering whether new or revised internal control processes may be required to ensure that the possibility of errors in financial reporting is reduced. I think a good exercise for companies to consider might be the mapping out of all the key estimates that are required to be made in preparing financial statements and the level of influence that climate change may have on those assumptions, as well as cascading this knowledge throughout the organization so that those working outside of financial reporting know the impact that their actions or decisions can have on the financial statements. We talked about the fact that climate risk can impact the financial statements under IFRS and the many estimates that can be impacted by such risks. It's also really important to take a step back and think about the impact of any non-financial ESG information that has been disclosed and think about the overall consistency between the financial reporting, management commentary, and ESG information. Is the company telling its story to stakeholders in a clear, consistent, and understandable way throughout these documents? Not operating in silos and ensuring that the financial reporting and ESG functions are talking to each other is usually the key in providing quality information.
Now, with the December year-end reporting season coming up soon, what I'd like to do is cover a few financial instruments related reminders. And I really have 3 areas of focus. First, expected credit loss considerations. Second, debt restructurings. And third, rent concessions. So let me start with the ECL considerations. Now, the expected credit loss model is a forward-looking model, and so it requires entities to use reasonable and supportable information about future economic conditions. Now, using forward-looking information applies to both staging, year 12 months versus lifetime considerations, as well as the measurement of expected credit losses. Now, COVID-19 is a significant worldwide event, we all know that, and that information by itself is considered reasonable and supportable, and so it's reflected in the estimation of the expected credit losses. But as we all know, the conditions are fast evolving, and so that estimate needs to be continuously refined. Now, at the current time, there's still a number of uncertainties, and that would mean that estimating ECL will continue to require significant judgment. So even if you have a short-term portfolio where lifetime losses and forward-looking information may not have been a significant issue in the past, forward-looking information could be meaningful in this current environment because, as we've seen, frankly, a lot can happen just in the span of a few months. So what should be top of mind at year-end from a financial institution's perspective? Well, there are a number of considerations heading into year-end. I'd like to focus on my top three: staging criteria, data and input, and measurement of ECL. Let me start with staging criteria. The key question there is, do staging criteria remain appropriate? Or are there additional or new information or indicators that now need to be considered and assessed? For example, does a vulnerability analysis need to be performed for customers on payment holidays in higher risk sectors and subsectors? In several jurisdictions, payment holidays have been extended, right? And generally, the likelihood of a significant increase in credit risk will be greater when a payment holiday is extended than when it was first granted. That's because with the passage of time, it'll become less and less likely that the payment holiday was necessitated only because of short-term liquidity issues. Of course, this will be dependent on facts and circumstances. Additionally, the impact of staging may have been incorporated in previous quarters by applying a post-model adjustment or a top-down approach that just changed the staging for a specific percentage of the portfolio. Now, for year-end, one would need to consider whether changes to the models themselves are required. For example, is there a need to move to more of a bottom-up or individual approach for that stage migration assessment? The other area around stage migration is really stage 3 or the credit impaired bucket. Now, while there hasn't been a change to the definition of credit impaired, entities should reassess their credit impaired indicators to take into account any new COVID-related circumstances or information and update those criteria where appropriate. Now, due to the payment breaks, the 90-day past due quantitative trigger for being credit impaired or defaulted has really been paused for much of 2020. And as a result, it's important to give appropriate consideration, but also weight to those other qualitative triggers, because otherwise there's a risk that the financial instruments or the assets would move to the credit impaired bucket too late. Now, what about the data and inputs? That's my second key consideration. We know that credit conditions are really changing quickly, and data that historically has been used to detect changes in risk may now be unavailable due to payment holidays. As a result, one would need to consider what other data may be available or may be soon available, how to source that data, and also how to incorporate it into the ECL process or approach. The other point is around subsequent events. Now, IFRS 9 requires expected credit losses to be measured in a way that reflects information available at the reporting date about past events, current conditions, and forecasts of future economic conditions. However, additional information that becomes available after the reporting date should be taken into account in measuring expected credit losses if it reflects conditions that existed at the reporting date. Now, in making that assessment, one will need to consider the significance of the event, including sort of indirect and second-order effects, but also whether the event simply confirms the existence of an uncertainty at the reporting date, rather than indicating the overall direction of possible future outcome, and whether that was materially different to what was originally estimated at the reporting date. My last area is around measurement. We know that in previous quarters, overlays and underlays or post-model adjustments were often used to address the shortcomings or their limitations with respect to the models or the data or where the risks were not appropriately captured by the models. Now, these model adjustments really might arise at various points in the estimation process, and they're also given different labels. So it could be a pre-model adjustment, and that could mean, for example, adjusting an input into a model, such as unemployment, to take into account the government relief programs. It could be an in-model adjustment, for example, just putting a cap or a ceiling on a value that's calculated within a model. or a post-model adjustment. That would really be an adjustment to reduce the modeled expected credit losses. Again, it could be to take into account those government relief programs where those are not fully reflected within your model. Now, because these models are inherently judgmental, they require robust processes, governance, and internal controls. And they also should be supported by transparent and high-quality documentation. But even as important is the fact that these overlays may actually require additional disclosures, or they may impact other disclosures, other existing ones, such as the ECL sensitivity disclosures. And these disclosures could really include or focus on inputs, assumptions, and estimation techniques. So let me switch quickly to key considerations from a corporate perspective. Again, corporates usually measure or calculate their expected credit losses using a provision matrix and typically follow the simplified approach. So I think there's 3 key considerations that are relevant to the corporates out there. The first one is groupings of trade receivables. Again, in the current economic environment, some trade receivables may be more impacted than others. And so the groupings may now need to be revisited because they may no longer be appropriate in the current environment. Second point is, again, adjustment for forward-looking information. Again, these could be general trends, changes in the economy, such as inflation, growth rates, or unemployment rates. There could also be further geography or industry indicators that could have a significant impact on those loss levels. And the last point is around consideration of alternative scenarios to develop this probability-weighted outcome. Now, an entity may need to use a scenario analysis that reflects future possible outcomes. It would then calculate the expected credit loss for each scenario, probability weight them, and then arrive at the total expected credit loss amounts. So those are my 3 considerations from a corporate perspective. Let me move on to another area that is important in today's environment, and that's debt restructurings. Now, again, recently, we've seen that due to COVID-19, debt restructurings are becoming more prevalent. Now, these restructurings can come in a variety of forms. For example, changes in terms of the debt related to payment holidays, new loans, or post-default modifications. So what needs to happen is that borrowers and lenders will need to determine the accounting impact of those changes, including whether they result in a derecognition of the loan or whether modification accounting is indeed appropriate. So let me start with the borrower. How does the borrower make the assessment? Well, under IFRS 9, if the revised terms are substantially different from the original terms, the borrower should derecognize the loan. Now, this would be a case, for example, if the present value of the new cash flows under the new terms is at least 10% different from the present value of the remaining cash flows under the original terms, using the original effective interest rate. However, the standard is not clear whether a broader analysis that also considers qualitative factors should be performed. So we believe that the borrower really has a policy choice. He could either just apply the quantitative 10% test, or it could choose to also perform a qualitative assessment. And that policy choice would need to be applied consistently and also disclosed. What about the lender side or the bank? How does the bank make the assessment? Well, there's not really an equivalent IFRS 9 model for the derecognition of renegotiated financial assets. So in practice, many entities might apply the same principles as for financial liabilities. If one concludes that there's a substantial modification, the loan would be derecognized and a new loan would be recognized at fair value. If the modification is not substantial, a modification gain or loss would be recognized in the income statement or in profit or loss. So maybe let's just bring this to life with a single example. So let's say the borrower has a fixed rate loan from a bank, and that loan is measured at amortized cost. The borrower then comes to the bank and applies for a payment holiday. The original loan agreement did not allow for any deferral of repayments. The bank would accept the borrower's request and agree to apply deferred installment and a contractual rate that is lower than the loan's original effective interest rate. Now, if we assume that a modification does not result in derecognition of the original loan, then the bank and the borrower would need to recalculate the gross carrying amount by discounting those revised expected cash flows at the loan's original effective interest rates. So that would result in a modification gain for the borrower and modification loss for the bank. And that gain or the loss for the borrower would be recognized in profit or loss. So let's switch to my last area, and that's rent concessions. Again, because of COVID-19, we've seen a lot of rent concessions being granted to lessees by lessors. Now, these concessions, again, can take a number of forms, including, for example, payment reductions or just a deferral of the lease payment. So what's the accounting? So let me start with the lessees first. As you may remember, a lessee can apply the practical expedient that was issued by the ISB in May of this year. Now, it only applies to rent concessions that are a direct consequence of COVID-19, and certain conditions need to be met. These conditions are that the change in lease payments results in a revised consideration that's substantially the same or less than the one immediately preceding the change. The reduction in lease payments should only affect payments due on or before June 30, 2021, and there shouldn't be any substantive change to other terms and conditions of the lease. So let's assume the lessee qualifies for this practical expedient and wants to apply that practical expedient. And let's take an example of a concession resulting in a reduction of payments. So the lessee would generally account for this forgiveness of the lease payments under the practical expedient as a variable lease payment and recognize the concession in the period in which the event or the condition that triggers those payment occurs. So let's assume the lessee has a lease liability that requires monthly lease payments of currency units of 100. As a result of COVID-19, the government has forced all stores to close until it decides that it's safe again to reopen. On March 31st, 2020, the lessor forgives the lease payments for April, May, and June on the condition that the store remains closed under government restrictions and there's genuine uncertainty about the timing of the reopening of the stores. The lessee would then recognize a credit of currency units 100 in each month, April, May, and June, and a corresponding debit of 100 to the lease liability in each month. And that's because of the condition that the store remains closed under those government restrictions. Now, in contrast, if the lessee was forgiven the lease payments at the end of March for payments due in April, May, and June 2020, without a condition attached to the forgiveness, meaning that irrespective of whether the store is allowed to reopen or not, the lessee would then recognize a gain for the portion of the lease liability that's forgiven on March 31st, 2020. Now you may wonder, what about lessors? Well, the short answer is these amendments or this relief that the ISB issued in May does not apply to lessors. So what a lessor has to do is follow the existing guidance in IFRS 16. So how would a lessor just account for a reduction in rents, similar to the example I just gave for the lessee, and assuming it's an operating lease? Now, IFRS 9 and IFRS 16 actually contain different guidance for the treatment of voluntary forgiveness of recognized amounts. And therefore, we believe that a policy choice actually exists for the accounting of a reduction in operating lease receivables. So the lessor could really consider the reduction in payment due for past rent to be a partial extinguishment of the lease receivable. So what does that mean? Well, the forgiveness would be recognized as a loss in the income statement or in profit and loss, with a corresponding reduction to the lease receivable in the period in which the reduction is contractually agreed. Alternatively, a lessor could also follow the modification guidance in IFRS 16. Now, this policy choice that relates to forgiveness of amounts contractually due for past rent is only applicable if it applies to past rent. So if a lessor forgives rent relating to a future period, this IFRS 9 guidance would not apply.
Over the last 9 months, there's been a lot of guidance that we've put out. I'd like to now talk about some of the key things to focus on as we bring what has been for many a crazy year to a close. And those things are impairment, presentation, and Brexit-related accounting issues. Let's kick off with impairment. Now, impairment has been a talking point during the current year due to the impact COVID has had on many businesses. It continues to be a talking point, and the level of uncertainty remains high. Some key things we need to continue to focus on are the following. The first is don't forget about post-balance sheet events. So following on from the uncertainty theme that I just mentioned, there'll still be a large degree of this uncertainty for a December period end. Examples of things folks might be grappling with in terms of their estimates include the impact of the recent COVID vaccine, how likely future lockdowns are, and the degree of continuing government support. Folks will need to exercise judgment, both in terms of deciding what might be an adjusting versus non-adjusting piece of information after year end, and if it is adjusting, how you should incorporate this into many of the estimates made at the period end. For example, impairment of financial and non-financial assets, net realizable estimates for inventory, and recoverability of deferred tax assets. I think the key message here is that it probably makes sense to have a more rigorous process than usual in place to monitor information that comes out between the period end and publishing of the financial statements. The second point is consistency in the forecasts used across the financial report. Remember that forecasts of information provided in the front half or in relation to going concern should be aligned in terms of their assumptions. Some other areas in the financial statements that might be considered to ensure consistency of assumptions include ECL and recoverability of deferred tax assets. Again, I think that the key message here is that your annual or interim report, which might be broader than just the financial statements, should tell the same story about what management expectations are for the future and how uncertain that future could be. Now, this might require entities to ensure that different functions within the organization are communicating with each other more closely than in the past. The third point is providing useful disclosure about judgments, estimates, and assumptions. And again, due to the increased level of uncertainty, there's a significant amount of judgment required in performing impairment assessments. Estimating whether an impairment is needed, and if so, the amount of impairment, will require the use of judgment. Disclosure about the key assumptions, and even more important than normal, in providing users with an understanding about how impairment or no impairment is recognized, and sensitivity disclosure as well as a clear explanation of the assumptions will provide useful information to users. Moving on to our second focus area, which is presentation and disclosure. There is likely to be a continued focus on presentation of the financial statements, particularly the income statement presentation and alternative performance measures. This year will be exceptional for many entities. These are some of the key areas that we think folks should focus on. The first is going concern. Many entities will have been negatively impacted by COVID-19. Unfortunately, some to the point where going concern becomes an issue. Where this is the case, it's important to be clear in the financial statements about the situation and what the entity is doing to address that. The second is APMs. And here you need to think about whether your APMs are IFRS or non-IFRS compliant. If they're not compliant with IFRS, for example, they are core or normalized EBITDA, then care should be taken in terms of where in the annual report they're provided and the prominence that they are given. I think the key message here is to make sure they don't fall foul of any guidance your local regulator may have issued with respect to APMs. And if you intend for the APM to be IFRS compliant, I think the key message then is make sure that it is actually IFRS compliant and they do comply with the requirements. For example, they are made up of only IFRS numbers and they can be reconciled, and they should not be presented with any additional prominence to the other IFRS numbers. The second point is to tell the story, both in your interims and in your annuals. Be transparent and complete. Ensure that the annuals and interims talk to each other and it all represents one complete story. One example of this is the IFRS 10 requirements on goodwill impairment. So if you've impaired your goodwill at the interim, make sure that you continue to tell the same consistent story when you get to your annual financial statements. Another could be around the assumptions used in general in impairment testing, or even the verbiage around going concern. Remember that in these uncertain times, in some cases explaining a key movement from your last interims to your annual financial statements might also be warranted. My next point is about key estimates, uncertainties, and judgments. In addition to the discussion that we just had on impairment, judgments and estimates might occur throughout the financial statements, as things are less certain than before. And entities will need to consider where additional information might be required to be disclosed to enable users to assess this additional uncertainty. And examples of this might include provisions, pensions, and taxes. Supplier financing arrangements. Now, folks might be aware that the IFRS Interpretations Committee has finalized its agenda decision on supplier financing. And to the extent that you have material supplier financing arrangements, it probably makes sense to take a read of the agenda decision in advance of finalizing your accounts. The last area I wanted to cover was Brexit. Now, I don't want to spend a lot of time on this because I tend to think of Brexit like I do IFRS 17, and that is, it might not be a big deal for lots of entities, but for those that are impacted, it probably is a big deal. And there are a number of issues that Brexit kicks out. Many of them regulatory, for example, what framework are you now reporting under, and can you still apply the exemption from preparing consolidated accounts? However, there are also issues related to the accounting, for example, taxes, restructuring provisions, and impairment considerations. I think the two key messages I'd leave folks with is the first being that this is not just an issue for UK groups. And the second would be that because of the completeness risk that this represents, it might make sense to at least have a plan for considering the impact, even if this results in you confirming that there are no issues for you.
We hope you'll find this webcast helpful as you navigate some of the key issues arising from climate risk in year-end financial reporting matters. Now, because climate risk is such a key issue at the moment, we're also preparing a more detailed webcast dedicated to climate change. So please keep an eye out for that separate webcast. Now, I know we've covered a lot of ground today, so I also wanted to highlight where to go for additional resources. In particular, I actually wanted to put a plug in for Viewpoint. What's Viewpoint? Viewpoint is our new digital platform for accounting and business insights. It replaces Inform, so if you're an Inform user, you should have received an activation email by now. Amongst other things, Viewpoint offers intuitive search functionality, a personalized homepage, as well as topic and industry landing pages. These pages are curated on a regular basis by our PwC subject matter experts. So if you haven't already, please go to Viewpoint. There's a lot of additional information on the topics we discussed. Thank you very much for listening to us today. Have a great holiday break, and we'll be back in 2021 with our Q1 webcast. Thank you, everyone.